So Jerome Powell has said that interest rates may go up faster than previously thought.
The real question is how fast can they go up before the whole banking sector collapses on itself?
That's right. Well, we've seen what that's done to Silicon Valley Bank. Rising interest rates have been a key component in their collapse this week because their original bonds that they bought over the last few years were not paying as much as the new bonds available at auction now. So when they had to sell those bonds, they were worth less because they paid less interest. So they made a $1.8 billion loss. But this week, Jerome Powell, actually, he was in Congress 2 days this week. And in that hearing, he made this statement. Let me read out basically a direct quote. He said, "The latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. If the totality of the data were to indicate faster tightening than is warranted, we would be prepared to increase the pace." Sorry, I got that wrong. If the totality of the data were to indicate that faster tightening is warranted, we would be prepared to increase the rate of rate hikes. And so most analysts are thinking that they're going to raise by 0.5 percentage points now rather than 25 basis points like they have done, I think, on the most recent rate hike.
Right. Yeah. He's talking about 50 basis points. And the reality is, is he trying to basically get us out of inflation, right? He's trying to raise the rates to make sure that he covers for the 6 trillion that was spent over the pandemic. And the truth of the matter is like, does it really affect us? Of course it affects us. And the thing is when you go to buy a car, your interest rate's up right now. You go to buy a house, your interest rate's up. He's really taking the money from the American people. And you got other countries like Canada. It's like, no, we're not raising interest rates. And then you've got Brazil, who's like, we're going to lower the interest rates. So it's like, what's really happening on a global scale, and how much is our money going to be worth? Is that going to start affecting like all kinds of stuff?
Yeah, it was interesting. Like, I think it was Elizabeth Warren who was questioning him, who, she doesn't necessarily always have the best economic ideas, but she was saying, you're raising rates. What about the tens of thousands of workers that are going to get laid off because of your rate hikes? Because the Fed is trying to solve inflation by sort of bringing on a recession. And they hope for a soft landing, a recession that's sort of not too bad, but they might not be able to achieve it. We may end up with a hard landing.
Well, it gets rough when we start to export our goods and people have to start using our currency, right? And they're coming in with yuan, they're coming in with, Australian dollars, Canadian dollars, pesos. They're worth less. So they're doing the same work, but it's worth less. And we're the only ones in the world, jacking up rates. Not saying we're the only ones. Europe's pretty much on the ball with it too, but we're going as fast as anybody else in the world right now, unless there's some no-name country. But when it comes to the G7, G20, we're leading the trudge out of the mud, and it's gonna be interesting here in the next 12 months.
And for those in the audience who maybe aren't as familiar with this, like when you raise interest rates, it causes people to invest in stocks less because things like government treasuries, bonds, bank accounts, just saving bank accounts pay higher interest rates. So people tend to take their money out of the market and put it into things like government treasuries, bonds, and bank accounts when interest rates are higher. Also with home refinances, no one's going to refinance their home and pull cash out when rates are this high. Last year you could do a refinance for like 3.2% and pull out your equity and use that to invest or buy a vacation home or a rental home or whatever. So no one's really going to be doing that now. So it constricts economic activity, and basically the idea of it is it kind of causes a recession. And the idea is to bring. Go ahead.
They kind of need the recession. Like how are they going to fight this inflation?
Inflation. Because to bring on deflation.
Yeah. Well, not only that, but what was inflation used in the 80s? How did they measure it? Didn't they change how they measured it?
That's right. So yeah, we've got that actually. Dom, if you pull up the shadow stats link, and possibly because Jerome Powell knows how high inflation really is. I mean, they're saying it's 6% now, but if you use the method that they used in the 80s, in the 90s, it's higher. Or if you use the method that they used in the 80s, it's higher still. So if we look at the 1980 base method, inflation would be at about 15%. Yeah, about 15%. That lower graph on there, you can just scroll down a little bit. The blue line on that graph would be using the 1980s. And the reason, the way that it's changed, the way they work it out is right now they account for substitution. So they measure a basket of goods, and then they think that when prices rise, let's say you would originally buy organic eggs, and now eggs are getting expensive, so you start buying regular eggs. Well, they assume that people are changing their spending habits to account for the inflation, so they use that in the example, and so it lessens the amount that goods have gone up by because they account for this substitution. But actually, if you were measuring the exact same basket of goods, inflation has gone up, double or more.
Yeah, and you can actually, when you hear 15%, you're like, okay, that actually feels real. When someone tells me inflation's gone up 6%, and I'm getting a car loan at 7.9, and the last time I got a car loan, it was at 1.9 or 0.9. I kind of look at it and go, yeah, this is way more offset than anything else that's going on. So if eggs are going to $7 a carton, they're like, nah, we don't need eggs anymore. No one eats eggs. We'll just put a bottle of water in there instead.
I'm boycotting eggs, man. I'm buying these tiny quail's eggs. They're about this big. But also, you can see it.
Get my own eggs.
You can see it in the supermarket. You can see it at the gas pump. Gas here in New York was $2.30. Now it's closer to $3.50. So that's sort of like a 50%, increase as well. So when you actually look at it and add it up, you're like, inflation's running higher than 6%.
Oh yeah, there's no question about it's higher than 6%. I mean, new mortgages right now are at a 30-year low. They're almost at a 40-year low. And the last time that happened was in the early 80s when you had
applications, right?
Yeah, applications. Yeah. And going back to 1985 when you had interest rate, you had interest of 14, 15%, and there's advertisements that are like, that's a good deal, but that's when your parents and your grandparents said, well, why don't we just get a savings account? Now you think of a savings account, you're like, I might as well throw my money away. You're getting, half of a percentage point if you're lucky. Back then you'd get 5%. So it was 1/3 of the going rate for a savings account.
I can remember in 2007 actually getting 6%.
Wow.
In a savings account. Yeah.
Where was that at?
That was in the UK. Maybe the US was a little lower than that, but around 5% or so was quite common back then, 2007.
Yeah. I don't know if we'll ever see it go that high. I mean, we have CDs that are starting to get back up there right now.
There are some savings accounts that are at 4% already.
Oh, okay. Well, then they're moving.
There are.
CDs are holding a little bit of cash, so that's always an advantage. You can play it to your, whatever card you want. But let's just hope that SVB is not systemic and Jerome Powell doesn't bring on the thunderstorm we don't need right now.
Yeah.
By altered statistics, and anybody's graph can change. Anybody's perception of data. That's the biggest thing about how money gets so dirty. Is they go, let's look at it over the course of one day. Well, look at the stock over the course of the entire lifetime. See what happened. Measure it against that. Look at inflation rates with a real perspective. Stop changing the goods you're going to put in. If you're going to measure with eggs and milk, you're going to measure with eggs and milk. Don't change the eggs to quail eggs, like you said. Just leave them the way they are, so at least we have a base to walk on. So that's the big fight that I think we're going against right now is like, the money's been altered since 1913 when they came in and started hammering us with the Federal Reserve and the income tax and all that. Like, how can we antagonize the people enough to make them believe that this is legitimized and we need it? Right now, a free market enterprise does not exist in the banking sector at all. There is none of that. And
I
so,
think Jerome Powell knows how manipulated it is. So he knows that the real inflation rate is quite a lot higher, which is probably why I believe probably next rate hike really will be 50 basis points.
yeah, well then who's dumping their treasury notes then? Who's next? If it goes up another 50 basis points, what do you think? Second quarter, third quarter? He said before, what did he say before the end of the year? It's going to go up 50.
Well, he said in increments of 50. So in theory, at the next Fed meeting, they might raise it another 50.
When are they meeting again? Do we know?
Yeah, the meetings are on the schedule. We can look it up, but I think it's here's the calendar.
When are they meeting again? Is he going to hit 50 base points after this news? Do you think he'll do it still?
Well, they're meeting, in March 21st, 22nd, and then they have a meeting in May. So I'm guessing probably they are going to raise by 50.
By 50 base points on the 22nd, 12 days after the collapse of the second largest bank.
Well, who knows? States. The way things are running right now, anything could happen, dude.
Yeah, right. Like nothing like blowing $1 trillion this year. We'll just add 20% to that. No problem. 1.2.
But all right, guys. So that's it for this one. Thanks very much for watching. Thanks for joining me, Mike.
Thank you.
Cool. And we'll see you in the next video.